Hey everyone, Jim Brees here from GreenGrowth CPAs, and thank you for taking the time to join us, the second part of our three-part webinar series today on sales tax. Last week we covered the basics of sales tax and why it's important that you accurately calculate your tax burden. Peter even dropped some insider knowledge about the CDTFA, potentially doing some audits in 2021. Big stuff here we're dropping on you. And the tax authorities, they're just waiting for enough liability to build up so that when they do audit you, they'll actually be able to find some pennies and dollars to get back from you. One thing about sales tax is this is something you cannot get rid of. This is something that you collect from a consumer and you remit, and you are just the custodian of the cash to give it back to the local tax authority. So today we're going to cover a nuance that's very, very important about destination versus origin calculations, important for the delivery services out there. And then lastly, I'd like to invite and to just introduce Peter Mantell. Peter, thank you for coming on today and sharing your deep knowledge of cannabis sales tax. We had a great time last week.
Thank you, Jim. Hello, all the way from sunny Las Vegas, from MJ BizCon, where we are at.
All right, well, let's go ahead and hop right in. Let's just start having the discussion here, Peter. If you want to walk us through kind of all the different things, I'll hop in if I have any questions. If you have any questions and you're watching the broadcast here, go ahead and drop your questions into the chat as we go through. We'll hit the Q&A at the end of this discussion.
So our conversation today is going to be around origin versus destination-based sales tax. And to be completely transparent, this is probably one of the most difficult types of sales tax to deal with in the entire U.S. California doesn't make things easy, especially when it comes into the tax arena. So we're going to help you understand how to maneuver in this space, and as either an accountant that supports dispensaries, or as a dispensary or retail owner, how to protect your business and what you need to be thinking about when it comes to the sales tax calculations, especially for California. Now, first and foremost, one of the big things that comes out of the gate is understanding what does origin versus destination mean. So some states have elected to the way they wish to charge sales tax, and we discovered the fundamentals of sales tax in our last conversation. Some states, when they want to run the calculations or how they want the sales tax to be applied by the local constituency, meaning the buyers directly in that state, some will say, okay, we want to charge sales tax based off of where this product is coming from. In that kind of environment, we call that origin based. And then majority of the rest of the United States really is more centric and focused towards what they call, we're going to charge sales tax where it's shipping to, and that's called destination based. So in other words, what this means is that depending on the state, you may have a responsibility to collect sales tax not only on where it's coming from, but where it's going to as well. Now, for those that have clients that are CBD dispensaries, or CBD retailers that are on the e-com space right now, because that's a very hot and upcoming product right now that isn't as tightly regulated as the cannabis is in various different states. This is where you have a lot of freedom, and this is really where you could lose your shirt, because CBD is becoming such a popular product right now as a health product as we speak, that people are just kind of buying wherever, investors are dumping funds into that industry, et cetera. And this is not any type of investment advice or anything of that nature, but just kind of talking about the overall encompassing industry. So to that degree, we go into California's case and what's going on there in the state. And what California requires is they require both origin and destination based. And what that means is that in California's case, and we'll have the PowerPoint attached at a later time, what they want you to do is when you have a sale, and let's just say as this industry continues to grow, the demand for delivery will also grow, because people want accessibility, kind of like DoorDash, or, when you want your food, you want it now. You don't want to have to go out of it. Or perhaps the consumer has indulged a little bit in the product and is not properly equipped to be able to go to get more or whatever have you. So in these kind of environments, we want to make sure that however you're accommodating to your clientele, that you're also protecting your business as part of the aspect. And so understanding this is critical. So first and foremost, let's talk about, let's just kind of run a scenario. So let's say, as a hypothetical, Jane Doe owns a dispensary operating out of San Jose, California. And Jane Doe has this unique type of product that, for whatever reason, the entire industry of the state just loves it. It's very popular. I don't know why. It's just a good product. And so she's getting demand, Jane Doe, from out of her San Jose location for product to Los Angeles or to other jurisdictions outside of San Jose. Sorry, that's my earbud there. And so what this means is that now the complexity from a sales tax perspective has now changed, and the landscape for Jane has also changed. Remember, everything we do is with an eye towards an auditor showing up and looking at your books. So when we evaluate proper techniques of maintaining data or handling it, we're doing it with the eye towards someday the boogeyman's going to show up at your door. And if you hear me say boogeyman, I mean auditor. So first and foremost, let's talk about the origin aspect. So Jane is selling from San Jose. She's fulfilling her dispensary in San Jose, actually grows there directly, her product, and they manufacture it there at that location. And so the first couple things we're going to look into is, what does Jane have to charge for John, who's in Los Angeles, who wants to buy product? Again, this is just a hypothetical. I know there's some other laws about transportation, et cetera, but for the example today, we're just going to use this. So first and foremost, what Jane's going to have to do is Jane is going to have to make sure she's accounting for first her origin, her address where she's fulfilling from. So she has some dispensary location in San Jose, California, and some Main Street, et cetera. And so what Jane's going to charge to go to John to Los Angeles, she's going to charge the state, which is going to be a flat rate of 6% in California. Then she's going to go for the county and city of San Jose where she's fulfilling it from. So wherever she's going to, so that order is either going to be fulfilled from San Jose, it's either going to be a driver or some kind of delivery method to the guy down in Los Angeles. So she's going to charge, on top of the state sales tax, the San Jose county and district tax. Then now the product is shipping to John over in Los Angeles. So then Jane is going to add also the Los Angeles district tax. So what we're looking at is a hypothetical. Let's just say, 6% for the state of California. The county for the San Jose area, as hypothetical, is 0.25%. And in the city for the San Jose area is also 0.25%. The district tax, and I apologize, I'm getting a little nerdy here, is going to, as a hypothetical for Los Angeles, let's just say 3.25%. So we have all of these numbers. What are we going to do with them? We're going to add them. So we're going to take the 6 plus 0.25 plus 0.25 plus 3.25, and that accounts for both your origin and destination, which is going to give you a grand total of 9.75%. Now, this is what's going to be collected from the client at the end, not accounting for also the excise and all the other components. We're just talking sales tax right now. So that 9.75% is what needs to be on the sales tax side, collected by Jane in San Jose from a client in Los Angeles. And then that's only one part of the whole algorithm here, or the process. The next thing that's going to happen is that Jane is also going to have to not only collect the various things, but then at the time of filing, she's going to go into the CDTFA form, and she is going to file said sales tax form with the information broken down. So this is a CDTFA form 401A that you'd be using in this kind of environment, and we'll have an example to send over to you all to look at as well. But in this environment, what's going to happen is Jane is going to have to break down a bunch of different components, both the sales tax, the use tax, based off of what the clientele had paid and it had remitted, and then also accounting for when it shipped, where it shipped to. And so within the form itself, to what Jim was mentioning a couple of minutes ago, the breakdown gets very complex very fast. I mean, you get into the Schedule A2 computation and the breakdown for the district tax in the long form, and the jurisdictions get broke down pretty heavily very fast in the state of California. Now, what happens if you don't properly account for these calculations? Well, if you over-collect and you remit the full amount of money, then the state will be satisfied as far as getting the revenue that was owed. But if in the event that you under-collect and you didn't properly account for the destination aspect of the sales tax, so you didn't account for the Los Angeles component of that district, in that kind of environment, if under audit and Jane had not properly collected it or reported it to the state, that liability now falls on the shoulders squarely of Jane and her dispensary. And, do that long enough, do that over a certain period of time, a month, 6 months, a year, and that number gets pretty aggressive pretty fast and pretty hefty. So you could see a 6-figure amount or 7-figure amount owed to the state after a certain period of time, depending on the quantity of transactions that Jane may have. So addressing this is critical and making sure that if you're conducting any type of deliveries, and that includes CBD, cannabis, edibles, any of those other things, that you're properly accounting for both the origin and destination, especially in California. Now, another state that will have some similar complexity for any of you accountants outside of California will be Illinois. They also have an origin component as well. They're not as complex as California's system, but they can tend to be a bit of a pain in the tuchus. So, I don't know if we want to come up for air for a minute or two here to let people ask random questions. Jim, let me know what you're thinking here.
Yeah, I mean, if you guys have any questions about this, so let me just repeat back what I'm hearing correctly, is that not only do you have to calculate the sales tax of where the product is shipping out from, but also where you're delivering it to. And you, as the business owner, you need to be able to calculate that tax specifically. So if there's 88 different jurisdictions in LA County, you need to make sure you hit each jurisdiction specifically. And as you go to do your filings every quarter for sales tax, right? It's quarterly filings, I believe, for sales tax. You need to break it down into a table of like, all right, $12 goes to this city and $3 here and this and that. Making a mistake on that can essentially create a huge undercollection, which then that penalty happens. What you were kind of alluding to was that Fresno, the 6 plus the 0.25, there's almost a 50% increase in tax by just bringing it into LA County.
Right.
That's a very popular county to be in California, and I'm sure there's a lot of people that are in Orange or in Riverside or up in Ventura that are delivering to LA County. This can be big money, right? So a delivery service can do, let's say, $100K top line. We're looking at $3,000, $4,000 a month, times 12. That's like $50K right off the bat. That's just collecting it if you do it the right way. Now you do it the wrong way. What are penalties for something like this if you miscalculate?
Upwards of 40% for improper filings. Yeah.
Yeah. Now you're looking at another, $25,000 in fines and penalties right there. So again, this is just 1 year.
Plus interest too.
Yeah. Plus interest.
Depending how long it's been at, at the standard rate, I can't remember, it's between 6 and 8% generally.
Gotcha.
That they charge, but
gotcha.
Yeah, above and beyond everything else.
Gotcha. Okay, cool. Let's just keep going down the slide then here.
Okay, cool. So the next piece that we're going to discuss then is what to do if in the event you haven't properly accounted for the origin and destination-based sales tax. First and foremost, if it's not properly calculated by your clientele, then the burden at that point rests squarely on your clientele's shoulders. So then at that point, there's really two options. Your retail client, if you're CPA, and then if you're a retailer, you can attempt to recoup the additional sales tax that was not collected by going directly to the clientele, though this is very unlikely that they're going to pay, because once the transaction is completed, nobody's going to respond back to any queries or questions or issues. This happened a lot on the e-commerce side with Amazon retailers where they didn't know they were supposed to be collecting sales tax, and then they find out from the states they should have, and then of course they're contacting their clientele saying, hey, can you please remove the sales tax? And clientele is just saying, pound sand, we don't care about you. So, this is one of those things, again, that, the state's not going to enforce that the buyers, that the clientele have to pay that sales tax. If you didn't get it at the time of the transaction, then it rests squarely on your shoulders. So what this means is if you're an accountant or if you're a retailer and you're currently today not properly accounting for these things, first and foremost, stop the bleeding. And that's the most critical thing is stop the bleeding. And that means start turning on the sales tax on the destination aspect as well as origin. Make sure both of those are being accounted for before you do anything else. Because the worst thing you can do is continue to compound and go into analysis paralysis mode. You don't want to do that. You want to stay focused, calm, and you're ahead of this, again, because really we're not expecting to see a lot of CDTFA involvement in California until January 1st, 2021. So there's time to correct this. The next thing is that the very next component is begin to run the calculations. So what that means is go back and look at all your transactions. You probably most likely everyone got the origin aspect, but people are probably lacking the destination. So then it's, to be aware and to be informed, and your clients, or if you're the retailer, as a retailer, you need to be aware and informed. What's going to be critical in all this is making sure that as far as your business is concerned, okay, I know that I didn't account for $5,000 in sales tax because I hadn't captured the origin aspect. But because I figured this out now from the webinar I had with GreenGrowth CPAs, I know to stop the bleeding, if you would. And so now I've now turned on that destination-based component. And then going forward, now I'm saying, okay, I'm collecting and remitting it. Now one thing you've done, you stopped the bleeding. You stopped any potential issues. If the client, the retailer, doesn't have the money today, there's a couple different ways you can approach this. You can go directly to the state and say, mea culpa, I made a mistake, and always do these things under the guidance of an accountant or a state and local tax expert. Don't just randomly go to the state yourself, because they'll take advantage of you that way. You want to have a professional that knows the inner workings of their law, but you can always proactively go to a state and say, look, mea culpa, I didn't properly account for some component of all this. What do I need to remedy it? And I can go and correct it. Some states will go and say, you need to do amended returns. So they'll have you go back and do the prior filings with the corrected amounts. And then at that time, they'll hit you with a little bit of P&I, penalty and interest. Other states will say, well, because you came forward, confirm the amount under what they call a voluntary disclosure agreement for your clientele. And then we'll accept that and remove the P&I. You'll just have to pay the background amount. Under that environment, and if the state's being friendly and willing to cooperate with you, they'll even often sometimes offer a payment plan. So let's just say you accumulated $10,000, $20,000. Right now we're in Q4 for, coming up on Christmas and then the holidays and the new year and everything else. Consumption may be up. And so you need that free liquidity of capital right now in the short term to handle the demand you have. And then after you get through this cycle, you can use the excess capital to pay off whatever debt you have. So this then comes down to, how do you wish to handle that debt? Do you want to deal with it immediately, and then that'll stop any potential for interest? Or, because of liquidity issues, do you want to go and take your time and pay it off, over a 11-month plan, if you will? So those are, again, steps as far as if you get, if you realize that you have a problem. First thing is recognizing it. I'm going to come back up for air for a second here, just see if there are any questions about what to do if you realize that there's a discrepancy in the sales tax information that you've been doing so far.
You said that the states want you to be as truthful as possible. You said there's like an amnesty kind of program, like, hey, tell us and report to us, what has actually been underreported. Do you see that you said they stop the P&I if you do that? If you kind of just come clean on your own accord?
It varies state by state. So some states will, we've dealt with states like Illinois, Texas, and et cetera, where even though you may have a license or registration there, for whatever reason, you just miss something. And then that's where what an accounting firm will do, or a state and local tax expert, SALT, they will approach the state directly and say, I have a client, and this is generally done anonymously. Unfortunately, in California's case, you can't do it anonymously. State requires you to turn it in advance. But in most other states, what you do is you come in and you say, okay, I have a client X, and client X recognizes that they have an overage of unremitted sales tax of $5,000, and they wish to come forward and clean it up. So what the state will say is, cool, we get what you're saying, we understand. So then what you do, they're going to say, send over the transactions of the delta. And it's almost like, the way they run through a voluntary disclosure agreement is almost like a mini audit. They go through the data points, you work with them and kind of confirming things, finding out what is sales tax, subject to sales tax, and what isn't, breaking it all down properly. And then once that's all done, the state will then come back to you with an assessment and saying, based off of the findings, we feel that you owe us X, Y, and Z. For your job, then to dispute if you have any questions over that. If you don't, then the next point is you accept, and then you move into the payment plan part. Now, in California's case, it's a little different because they require, as part of the voluntary disclosure agreement, you actually have to remit the name of the retailer at the time that you're requesting it with the state. So that's a little bit more scary and a little spookier. Then the other thing associated with that in California's case is that after they still assess the P&I, penalties and interest, at the time of the voluntary disclosure agreement or the amnesty. But what they do is, once you've completed the entire process, the state will allot for you to then apply for exemption for the amount that you had previously remitted to the state in relationship to the penalty and interest. And the reason why they do that is to maintain and preserve control. So if for any reason at some point during the voluntary disclosure agreement process or amnesty process, if you disagree to cooperate, then the state reserves the right to be able to then tack on those extra components.
That makes sense. All right, cool. I don't see any questions in the chat, so let's just keep going down the next portions here then.
Awesome. So kind of to conclude this entire conversation and to close it all out, bring it full 360, we discussed last week the sales tax 101, what it means. This week we discussed the difference between the delta in origin versus destination and what needs to be accounted for at the time when you're doing that. The next week we're going to then continue onward as far as discussing the what do you do if you get contacted by the state? So let's just say hypothetically an auditor shows up at your doorstep. It's after January 1st, 2021 in California, or in other states like Massachusetts that are just coming out, or Illinois in the future. They're just slamming out audits just to make examples out of people. On the next webinar, we're going to actually go onward and continue to discuss what to do in that kind of environment and how to handle it. And a couple of pointers in advance, I will tell you prior to this call next week. You treat the state as an accountant or as a retailer. You treat them as if a police officer showing up at your doorstep asking random questions that you don't want to answer. You always reserve the right to not have to respond or answer to them. And in those types of environments, and what we're going to be discussing is the power of attorney. So in other words, what does that mean for the accountant or the audit defender, whoever's doing that in your representation in your stead? How to protect your business from accumulating any greater liability if under audit, and then what things you should consider, especially in regards to, if you've done something wrong or there's area, what do you do proactively versus reactively responding to said issue? So a lot of that stuff we're going to cover in the next webinar. I think that'll be really super informative, especially if you're in the accounting world, as to what to do when dealing with the states and what their power is.
That's it. Good deal. Good deal. So anything else for today then?
I think we're good. If there aren't any other questions in relationship to the origin destination, the last thing I'll close out with is saying, for any accountants or retailers, a lot of people right now are currently using point of sale systems. Just to name a few trees, MJ Freeway, Blaze, etc. And one critical piece here when using whatever system you're using, Flow Hub, etc. A lot of them will bolster in their marketing saying that we calculate sales tax. And to a degree they do. What they do is they allow you to manually input the sales tax data into the actual point of sale system that they're using for filing purposes. But if in the event, if for any reason there is any type of any type of issue whatsoever in relationship to they don't,
You indemnify them pretty much. You're putting the numbers in yourself, right?
Yeah. So if their whole thing is we're not responsible for the actual calculations. So one thing to also make sure of, and this is a critical area, and then solutions like Cannabis Taxware will assist with something like this because it allows for a real-time rates call. But always make sure when it comes to the calculations that you're using a solution that has the exact rates, because even if you thought you properly calculated but didn't have the right rate, and you're continuously doing that calculation at the wrong rate, now your business has exposure. So some things to think about in the origin destination, or some homework for everyone here listening to this presentation today. Make sure that you are at any given time checking the calibrated tools and making sure that whatever you're charging from a rate perspective is accurate. And those rates can fluctuate from month to month. So it's critical that you are keeping an eye on that.
Yeah, I put in the chat here, greengrowthcpas.com/Cannataxware, CANNATAXWARE. It's linking out to their site, and you can learn a little bit more about how their software application can plug into and pull information from your POS system to make sure things are being calculated exactly or as close to exact as possible on your end, but surely exact on Cannataxware. And then you can find those discrepancies sooner rather than later. You don't want to be 6 months in and be like, oh man, we have really exposed ourselves to a lot of penalties. It'd be better to find out, 2 days we've undercollected $27. Let's just, keep that going forward. So greengrowthcpas.com/Cannataxware. There should be a little pop-up as well during the presentation here. You'll see that as well. And then in the email that I'll send out tomorrow to everyone that's joined, as well as to our list, check out Cannataxware, see what they can do to help out and move your business forward in calculating the proper sales tax.
Thank you so much for inviting me, Jim. I really appreciate it.
You're very welcome. Well, thank you for having all this information for us and sharing all the information. Everybody, thank you for joining today. Again, the third part of our series will be next week, December 18th at 12 noon.